why your savings account is losing money. High Yield 2026 update. You think your cash is safe because it's earning interest? Guess again. Your savings account is essentially a slow leak money bucket. It looks full, but over time it's leaking purchasing power. Because in 2026, money sitting in traditional savings is losing money even when it earns interest. Here's the brutal math. If inflation is 3% and your account yields 5%, you only earn a 2% real return. That's not growth. That's barely survival. And if yields fall, as virtually every institutional forecast suggests, that real return margin shrinks even more. Today, we're going to break down why your savings can actually lose value, what savers commonly misunderstand, and how to protect your money in 2026. No hype, no slogans, just data, the problem/opportunity. Let's step back. 2026 is not 2016. It's not even 2023. The economic environment has shifted. Here are the pillars of this new reality. Round pushpin Fed rates stabilized around 4.5%. After years of volatility, rates have remained elevated relative to the last decade. This affects everything: borrowing costs, yield curves, savings products, asset pricing. Round pushpin high infrastructure demand. Governments and corporations are investing in energy systems, data infrastructure, supply chain modernization, AI build-outs. This drives real-world asset demand. Round pushpin shift to real-world assets RWA. Institutional capital isn't chasing memes or momentum anymore. It's chasing cash flow, assets with intrinsic economic value. This matters because real returns are now tied to actual economic output, not just stock price inflation. But here's the wealth gap. Most retail savers are still stuck in 2020-era cash strategies. Savings accounts, certificates of deposit, traditional money markets. Meanwhile, the top 1% are leveraging yield optimization structures, cash allocation strategies, real asset exposure, liquidity tiers. The problem isn't that savings accounts are bad. It's that they don't keep up with the new economic regime. And most investors haven't updated their playbook. Pillar 1. High-yield savings accounts. Truth versus myth. Let's dig into what high yield really means in 2026. Some online banks advertise rates as high as 5% APY. That sounds great compared to brick-and-mortar banks that still offer 0.2% to 0.5%. But there are hidden realities. Truth number 1, these rates are variable. Unlike fixed CDs, savings yields can change at any time. Banks adjust them based on federal funds rate expectations, competitive pressures, deposit flows, a liquidity needs, meaning your 5% could be 4% next quarter without notice. Truth number 2, inflation still matters. Higher yield doesn't automatically mean growth. If inflation is running at 3%, a 5% yield gives 2.0% real return. A 4% yield gives 1.0% real return. A 3% yield gives 0.0% real return. Anything below inflation means negative returns. Truth number 3, most financial institutions are already cutting rates. Data from early 2025 shows some high-yield accounts already fell below 4.5%. Several banks trimmed posted rates as liquidity constraints increased. Rate competition is declining. This suggests future downward revisions are likely. The psychology of savings accounts. Here's something most advisors won't tell you. Savings accounts feel safe, but they can be dangerous in disguise. Because heavy checkmark, you see your balance grow. Heavy checkmark, but you don't see purchasing power shrink. It's like watching your car's speedometer go up while the fuel gauge drops faster than you realize. Liquidity is like oxygen. You don't notice the cost until it's gone. Hypothetical example, the $1,000 real return model. Let's run the numbers. Scenario A. You invest $1,000 at 5% APY. Year 1 interest equals $50. End balance equals $1,050. But if inflation is 3%, then your real purchasing power is only equivalent to about $1,019, meaning you earned interest, but your real value only increased marginally. Now, imagine the yield drops mid-year to 4%. Your real return shrinks even more. That's why a savings account, even a high-yield one, may not keep up with the broader cost of living. What most investors don't realize. Most people think, but that's math, not logic. Here's the reality. High nominal yield is not equal to real growth. And when yields are variable, that gap widens. The bridge to Pillar 2. So, if high-yield savings aren't enough to protect your purchasing power, what are the smarter alternatives? And how can you use other low-risk strategies to actually grow cash in 2026? We'll dive into that next. Pillar 2, short-term U.S. Treasuries, the yield upgrade most savers ignore. Here's something most retail savers don't understand. Banks don't set the ceiling. The bond market does. When the Federal Reserve stabilizes rates around 4.5%, short-term Treasury bills often yield close to, or sometimes above, what online savings accounts offer. And unlike savings accounts, Treasuries are backed by the full faith and credit of the U.S. government. This isn't theory. This is structure. You can access short-duration exposure through vehicles like iShares 0 to 3-month Treasury Bond ETF, SPDR Bloomberg 1 to 3-month T-bill ETF. These ETFs hold ultra-short Treasury bills, minimal duration risk, high liquidity, institutional-level yield access. Why this matters: technical breakdown. Savings accounts are deposits. Treasuries are securities. Deposits depend on bank policy. Treasury yields depend on the yield curve. When the yield curve remains elevated on the short end, short-term Treasuries can outperform savings accounts, especially when banks start trimming promotional APYs. Key metrics to understand. Yield curve positioning. Short-term rates often reflect Fed policy more directly. Duration risk. 0 to 3-month funds have near zero price volatility. A credit risk, essentially negligible relative to private banks. This is not about chasing return. It's about upgrading idle cash. $1,000 growth model, Treasury version. Let's compare. Scenario: $1,000 in a high-yield savings at 4% versus $1,000 in short-term Treasuries at 4.6%. Savings return after 1 year. $40, $1,040. Treasury return after 1 year. $46, $1,046. That's not dramatic, but scale matters. At $50,000, savings earns $2,000. Treasuries earn $2,300. That's a $300 difference for doing essentially nothing different, just reallocating. Now compound that over 5 years, assuming similar spreads. Small differences in yield create large differences in total return. That's how institutions think. Retail savers rarely do. The limitation: Treasuries protect capital. They don't meaningfully outpace inflation long-term. They are a defense layer, not a growth engine. So, if your goal is just preservation, this works. But if your goal is purchasing power expansion, we need something else. And that leads to Pillar 3. Pillar 3, money market funds and cash optimization account. Here's the irony. Many banks pay you 4%, but they turn around and invest your deposits in instruments earning 4.5 to 5%. They pocket the spread. Money market funds cut out part of that middle layer. Instead of earning deposit rates, you earn market-based rates. Two major examples: Vanguard Federal Money Market Fund, Fidelity Government Money Market Fund. These funds typically track short-term government yields, which means when rates rise, yield adjusts upward. When rates fall, yield adjusts downward. But spreads tend to remain competitive. Advanced metrics to understand. Money market funds focus on short-duration government securities, high credit quality instruments, stable net asset value, typically $1. Key difference: Savings accounts equals FDIC insured. Money market funds equals SIPC protected brokerage protection, not deposit insurance. Risk difference? Minimal for government-only funds, but structurally different. $1,000 growth model, money market version. Assume savings APY equals 4%. Money market yield equals 4.7%. $1,000 after 3 years. Savings $1,124. Money market $1,147. That's $23 difference on $1,000. Scale that to $100,000. Now, you're talking $2,300 difference. That's real money. And that's without taking equity risk. Why the top 1% rarely use plain savings? They tier liquidity. Tier 1, immediate cash checking. Tier 2, yield-optimized liquid funds, money markets, treasuries. Tier 3, income-producing assets. Retail investors often stop at Tier 1 and Tier 2. Institutions go further. And that's where the wealth gap widens. The bridge. So far we've upgraded cash, but we still haven't solved the core issue. Inflation. If inflation remains 2 to 3% long-term, and cash products yield 4 to 5% in a declining rate cycle, your real return margin will compress, which raises the final question. What if the real solution isn't maximizing savings yield, but reducing reliance on savings altogether? Pillar 4, dividend-paying free cash flow machines, the inflation counter. Let's address the uncomfortable truth. Cash products preserve capital. They rarely build wealth. If your entire strategy is optimizing between 4% and 4.7%, you are playing defense. And defense alone does not win long-term purchasing power. This is where selective dividend-paying equities enter the conversation. Not meme stocks, not speculative growth. Cash flow businesses. Examples include broad, quality-focused ETFs like Schwab US Dividend Equity ETF, Vanguard Dividend Appreciation ETF. These funds emphasize strong free cash flow, sustainable payout ratios, low debt to equity, profitability screens, reasonable PE ratios. This is critical because dividends funded by debt are fragile. Dividends funded by free cash flow are durable. Why this works in 2026? We are in a higher rate regime. Cheap capital is gone. Companies with strong balance sheets, high return on equity, consistent earnings growth, outperform long-term. Dividend growers historically provide income, capital appreciation, inflation protection. That's a triple advantage compared to a static savings account. $1,000 growth model dividend strategy. Let's assume dividend yield 3.5%, dividend growth 6% annually, price appreciation 6% annually. Total average return is almost equal to 9 to 10%. $1,000 invested for 10 years. At 4% savings, yield $1 for 80. At 9% dividend growth return $2, $367. That's nearly $900 difference on $1,000. Now, multiply that over larger capital. This is how purchasing power expands, not by squeezing 0.5% extra APY, but by allocating part of your capital toward productive assets. Risk management, the margin of safety framework. Let's slow down. Equities are volatile. Dividend ETFs can decline 20% during recessions. That's why this is not an all-in move. The margin of safety in 2026 means maintain 6 to 9 months of expenses in optimized cash. Avoid high PE speculative equities. Focus on companies with strong free cash flow. Diversify across sectors. Cash is stability. Dividends are growth. Treasuries are protection. Structure matters. Black swan scenarios. What could break this thesis? Rapid Fed rate cuts. If rates drop sharply, savings yields collapse. Treasury yields fall. Money market returns decline. Liquidity crisis. Credit markets freeze. Equities drop sharply. Dividend stocks decline short-term. Unexpected inflation spike. Cash products lag again. Bond yields reprice. Markets experience volatility. Geopolitical shock. Energy spikes. Supply chains disrupted. Global equity markets reprice. No strategy is immune. The key is balance. Liquidity is like oxygen. You don't notice it until it disappears. 2026 Outlook, the cash illusion. We are transitioning from a rate spike era to a rate normalization era. That means savings yields likely trend downward. Banks reduce promotional rates. Spread compression increases. Meanwhile, institutional capital rotates into cash flow businesses, dividend growth, real-world asset exposure. Retail investors who stay parked in savings accounts will feel safe. But safe does not mean ahead. And over 5 to 10 years, the difference compounds dramatically. The 3 non-obvious takeaways. High yield doesn't mean high growth. Nominal return is not equal to real return. Small yield differences scale dramatically. 0.7% difference matters over time. Cash is a tool, not a strategy. Savings accounts are for liquidity, not long-term wealth creation. Exact action plan. Step 1, audit your current cash. If it's in a traditional bank earning under 1%, move it. Step 2, tier your liquidity. Checking savings or money market short-term treasuries. Step 3, allocate excess capital toward productive dividend assets. Step 4, reevaluate quarterly, not emotionally, strategically. If you want to see exactly how to structure your liquidity tiers in 2026, check the 2026 Portfolio Tracker in the description. It shows cash allocation percentages, yield optimization structure, dividend modeling projections. Stop letting your bank profit from your idle cash. Make your money compete. Comment question. Let me ask you something. If inflation averages 3% over the next decade, do you think a savings account alone will protect your future? Or is it time to upgrade your strategy? Drop your answer below, because financial safety and financial progress are not the same thing.